Hello everyone, welcome to today's video. Today what we're going to look at is how to select your own mutual funds. How to select your own mutual funds. So, this is the topic for today, mutual funds. So basically I will give a very brief introduction of what exactly is a mutual fund and why do you want to invest in a mutual fund, right? For example, suppose you want to enter into the stock market, right? You want to enter into the stock market, and when you go into the stock market you have like many stocks, right? You have HUL, you have Infosys, you have TCS, and you have all these stocks, right? And you want to invest in the stock market but you not know how to invest in the stock market. You hear that people talk about fundamental investing, you hear people talk about technical analysis, and your brain completely gets fuzzed up, and you say, well, I'm tired of it. I don't want to do anything with the stock market, which is one of the most dumbest things to say, because mutual funds or the stock investing is one of the best ways to grow your money. In fact, it's the best known way in which you can actually put your money and grow it, right? So I think you must have heard about mutual funds from your parents, right? You must have heard it a lot of times. When you grow up, your parents would say, well, keep some of your money in the mutual funds. But then again, what mutual funds do you want to invest in? There are large cap mutual funds, there are small cap mutual funds, there are mid cap, there are flexi cap, there are multi cap, there are all sorts of mutual funds. There are mutual funds which also invest in the US stocks as well. Some mutual funds invest in both US stocks and Indian stocks as well. So let me help you today to select your own mutual fund, and I will also be telling you some of my favorite mutual funds. I generally do my investing through a fundamental stock investing. If I ever do a mutual fund investing, I would only do it in the ELSS funds. I would only do it in the ELSS funds. If most of you are employed, are working, you're salaried, and you're getting your salary every month, you do not know where to put your salary because you want to save taxes, people advising you a lot. If you're someone who is young, who is like in the 20s or in your 30s or maybe in your 40s as well, right? You're not in your late 50s. So where do you want to park your money so that your money should grow and completely help replace your diminishing human capital into protective financial capital? What is the method for doing it? The best way to do it, the best way for it is to invest in the stock market. And today we're going to talk about a method of investing in the stock market, and that method is mutual fund investing. So basically, suppose I will just start with the most uh, simple of mutual funds. I just want to classify the mutual funds first and foremost. So generally mutual funds are of two types, right? Mutual funds are of two types. There are active mutual funds, right? There are active mutual funds and there are passive mutual funds. Now you might say, well, what is an active and what is a passive mutual fund? When you're actually investing in an actual mutual fund, what you're basically saying is, I'm not going to manage my portfolio, right? I'm not going to manage my portfolio. I'm going to let some expert, someone who is like a fund manager, maybe he works at HDFC or Kotak, maybe he works in Parag Parik Mutual Fund, maybe he works in Motilal Oswal Financial Services. So there are there are a lot of fund managers and they are experts in the field, and these people select the stocks and they maintain the portfolio for you. What you have to do is to just keep your money invested into the mutual fund as you go on forward. So basically what you're basically doing is, for example, maybe you're earning some 50,000 or 60,000 rupees salary, right? You have some 20,000 or maybe some 35,000 going for the expenses, or maybe 30,000 going for the expenses, right? This completely has your all needs and desires, maybe your room rent and maybe your food allowances and all the stuff. Maybe you want to go out and enjoy, you want to eat something. So all this stuff, right? After taking away all that stuff, you're left with some 15,000 rupees. And now you want to invest that 15,000 rupees. And how do you do it? The best way, if you're in your young ages, would be putting a large chunk of your money in mutual funds, right? So you have to be very careful while selecting a mutual fund. It's not that mutual funds do not give you returns, it's that you could have basically achieved that return by even being a passive investor. That's one of the main reasons why I want you to very carefully watch the video, right? So in active mutual funds, what generally happens is there is this fund manager who basically manages the fund for you, and obviously he's not going to do that for free. he is somebody who will charge a commission from you, right? The fund manager will charge a commission from you. So this commission, like how much should this commission be, right? So the commission typically varies between zero point 0.4, it can go as high as maybe 1.5%. You might say, well, this is actually quite less, 0.4 to 1.5%, but believe me, it really matters over a long time, because compounding is the eighth wonder of the world, as I often say. The one who understands it earns it, and the one who does not understand it pays it. It's as simple as that. Okay. So an active mutual fund manager, he manages the portfolio for you. You don't have to go with the headache of picking your own stock, and whether the market is up, whether the market is down, he takes care of it for you, right? And there are various ways in which he does that. Sometimes, okay, let me first clear you what is a passive mutual fund, then we can get deep into an active mutual fund. So an active mutual fund manager, he selects your own stocks and he charges the commission, as simple as that. Passive mutual fund investing is mostly index investing. Yesterday in one of my video, if you haven't seen it, you can go and watch that video, in which I have told you that index funds are one of the most low cost mutual funds that are available for you in the market. They are low cost mutual funds, and what you're basically doing is you either select your index, which is typically Nifty in India. It consists of top 50 companies by the market cap. You have this whole, like, let's take this heap chart, and you will have the proportion, right? So the largest one would be Reliance, the second one I think is HDFC. So by proportion of its weight, the fund will be investing. You know why this is considered? This is generally considered the market's average return, right? Over time, you believe that this basket of stocks in their respective proportions will be doing very well. I am just basically writing all the stocks names just to fill it out, just because the spaces are there, let's fill them away. So you have Havels as well, you have Pidilite, right? So these are all some of the well-known stocks in the industry, and you're basically saying that this basket of stock that I choose, and whatever the market capitalization would be there, I've explained market cap in my previous video. Maybe you can go and check that out. So right now, if you invest in the Nifty, you're basically investing in all these other stocks, and according to the proportion of that particular stock in the index. If the Reliance currently is at 8%, so 8% of your money is gonna be going into Reliance. It's as simple as that, guys. Okay. But in an actual active mutual fund, it depends upon the mutual fund manager. For example, the mutual fund manager likes to only have maybe 15 stocks in his portfolio. He says, well, I don't believe that holding all these 50 stocks is really a matter. I'm going to concentrate my whole money into just few stocks. Maybe he says, well, I'm going to have HDFC, TCS, and Infosys in higher proportions when compared to some other companies such as Reliance or Energy, or maybe some high infrastructure oriented and high leveraged industries such as the communication industry. The best example for that would be the Bharti Airtel, which is a stock I really don't like. I will explain in another video why I don't like the stock Bharti Airtel, right? So that's it, right? It's as simple as that. He selects his own stocks, whatever proportion he chooses, and he invests in that. So basically, if you generally select a mutual fund, always remember there is something called as assets under management. This is AUM, right? When you're selecting an active mutual fund, let me open a new section for you guys so that you can actually uh, op- do that in there. So in active mutual fund investments, so when you're typically doing an active, so always remember, always have a look at AUM typically means assets under management. Assets under management, so it typically is the total amount of money that is managed by the mutual fund manager, right? So typically, I would say the assets under management should be very high. I think if it is above, like maybe say 500 crores. See, the Indian mutual fund industry is very big. Okay, it's very very big. But typically, I would say always choose a good assets under management, because you see, the larger the assets under management, the more less your expense ratio would be. Okay, it also typically depends upon other factors as well. But one of the main important factors that you have to look at in the portfolio, that you need to consider, is you need to see the assets under management. So if it is above 1,000 crores, typically the amount of expense ratio will actually be quite less. But if it is actually maybe like only 10 crores in the portfolio, he will be charging you like 1.5%, which is just stupendous, which is just preposterous. Okay, so don't do that. When you're selecting your own mutual funds, always select the fund which has a large assets under management, and from the large assets under management mutual funds, select the mutual fund which suits you better. Right, the second thing that you need to see is to go and see the expense ratio. Right, typically some of the newer mutual funds which are just very young, they are going to charge a very less expense ratio. Maybe he wants to like gain some traction, but don't go for that. See the expense ratio. I would say the optimum would be, if you're going to an actual mutual fund, zero point 0.4 to zero point 0.8. Right, there's a particular mutual fund which I particularly like, and if you like it, maybe you can invest your money into that, and I'm going to provide you with the proof also, like why do I like it and why should you buy it when opposed to other mutual funds. Right, so 0.4 to 0.8%, this should be your optimum expense ratio. And the next thing you need to see is to just go and have a look at the portfolio, or not the portfolio, but rather the name of the fund. Generally, there are different kinds of mutual funds. Okay, like in the mutual funds as well, you have large cap mutual funds, you have small cap oriented mutual funds, you have mid cap. See, the small caps and the mid caps, ladies and gentlemen. Large cap means, when I was talking to you about nifty 50, nifty 50 is a large cap index. Right, it only has the largest stocks, the top 50 stocks by market capitalization. So it only consists of those stocks which have a market capitalization of greater than maybe 20,000 crores. Right, this is the market cap of those stocks. So large cap are generally those stocks which have a market cap of greater than 20,000. Mid cap would be some 5,000 to 20,000. Small caps are generally which are, between less than 5,000. And you have your large cap. This one would be greater than 20,000 crores. Okay, it's very important to know. Remember, the larger the market capitalization, the less risk you'll be taking. See, mid cap and small caps are companies which are very small a little bit, and as I said, mid cap means medium market cap companies. So even though the amount of returns maybe that you will receive over time can be more than when compared to large cap stock, there is a lot of volatility. For example, if you're taking large cap stocks, if there is a market breakdown happening, then maybe they would go down like this, and again they would come up. But if you go to the small cap stocks, they can go up very rapidly and they can come down very rapidly. So when you are investing in mutual funds, always see what kind of investor are you, what is your risk tolerance. Are you a more risk tolerant investor? Do you want to take on more risk? But it's not that if you're young, it's much more advised for you to invest in small cap stocks, but that doesn't mean that you should go and put your money all in small cap and mid cap mutual funds. Never do that. Okay, never do that. Always be a little more considerate when determining you. I would say the correct proportion would be 60 or maybe 50, 30, 20. When you're young, invest 50% in large cap, 30% in mid cap, 20% in small cap. This would be a right proportion. You might say, no, I don't like small caps, I only want to invest into the large cap and the mid cap itself. So you can say, yeah, I will say 70-30 or 60-40. Maybe you can also do that, but it's according to you. If you believe that smaller companies will find a lot more growth coming to the future, which undoubtedly they would. Generally, small cap stocks are generally um, thought to be providing more returns when compared to a large cap stock. But in if you compare the returns for the past 10 or 20 years, the large cap stocks have done considerably better. But that doesn't mean, just because the past has been better for the large cap stock, that doesn't mean that the future will be better for them as well. See, the stock market is a forward looking machine. You're looking at the future, you're not looking at the past. Okay, the past is something that needs to be considered. It doesn't mean that you will go and, okay, Ashish, actually my name is Ashish, so you will not just basically go and say, hey, the stock has performed very badly, it has just given 5% return on a year every year, I'll go invest my money in it. If there is such a mutual fund which is only giving you 5% return, do not go and invest. It should have a minimum very good CAGR. CAGR means year on return. It should be about 10%, okay, over time. But typically, you need to see for all that stuff. See the previous year CAGRs, as I said right now. Select only those stocks which have greater than 12%, not greater than 12% as well. I would say greater than or equal to 13 point, maybe I would say 14%, guys. You know why I'm saying this? Because the amount of expense ratios that this guy is going to charge for you, that also needs to be considered, okay? It's not like the so why am I stressing so much on this? My FD gives me 5%, this fund is giving me 12%. Why isn't it better? See, you should not compare an active mutual fund with your returns in your FD or returns on your real estate that you own. You need to compare it with the other mutual funds in the same category, okay? When you're comparing this large cap mutual funds, always see how did they fare against the Nifty 50 index fund is basically a very simple strategy. Whatever is there in the index, in whatever proportion it is there, you're going to buy it, right? It's as simple as that. If by doing all this active mutual fund investing, you are giving some commissions to these active mutual fund managers, and these fund managers fail to beat the index, fail to beat the passive style, then why exactly are you investing in that? Are you want to pour money to the mutual fund managers? That's why I would advise people to go and actually select your own stocks. But I know that many people are not going to have time. But even if you do, even if you don't have that much time, at least put some more time into selecting your best mutual fund. Maybe that would help you see, look at the history. We're going to check that. We're going to use sticker tape for it. It's the tool which I use for analyzing my mutual funds if I ever do invest in mutual funds. But yeah, typically I would believe right now I'm investing in mid cap mutual funds, because I really do believe that the mid caps are going to give very good returns in the future. But that's my perspective, right? If you're just beginning, I would advise you to start a little bit lower. Okay. mm, Maybe you start with large cap and mid cap, and maybe as you go on, as you understand the process of mutual fund investing, right, you will be able to make your own decisions. Like, you can take on more small caps funds in your portfolio, or something like that. So that's one part. So the CAGR should be greater than 14%. The portfolio should be maybe a large cap, mid cap, small cap. Select that expense ratio should be 0.4 to 0.8. The CAGR should be greater than 14%. And what else you need to consider? You need to see whether you're getting some tax exemption when you're investing in that. So the government has these funds which are called as, let me go to a new section. The government has a set of funds called as ELSS funds. What are these? Equity linked saving scheme funds, right? So these are generally they have a 3-year lock in period, and they are exempt and exempt. They are only double exempt, not triple exempt. That means whatever profits you're going to get from this, 10% of that is going to be taken as 10% as capital gains tax. Capital gains, okay? It's very important to learn this. As you draw whatever profit you're going to get. That's one of the main reasons why I say select a very good mutual fund. Always invest into that for the long term. You see, compounding only shows its power when you are investing for a long time. So always remember, it's not the timing in the market that matters, but the time in the market. It's one of my most favorite quotes. Always remember that. It's not the timing in the market. So when are you entering? Is the market high? Is the market low? That doesn't really matter. I mean, if you're somebody who's selecting your own stocks, maybe that really matters. But you don't know what's going to happen today or tomorrow, right? So what you're basically saying is Indian economy will be growing, and my mutual fund manager will be generating the same returns, or on the same magnitude of returns that he has been doing in the past. That is what that you're basically believing in. So um, equity linked saving scheme, right? You can check across all these mutual funds, ELS schemes as well. I'm going to show you some of them. as I said, I'm going to recommend you one fund which I think I really like a lot, and I invest 10% of my portfolio into that mutual fund. But maybe you can even think about investing like all of that, because I generally take a lot more risk because I select my individual stocks. You don't have to do it, it's just the way I do it. So you can just basically go to this ELSS schemes, and they have a 3-year lock-in period. So let me select few stocks for you, few mutual funds for you, so that you will get an idea. Or you can just be completely passive. Oh, Ashish, what is this selecting our own funds and everything? I don't want to do this stuff. I'm going to select my own mutual fund, and I want to be a passive investor. What I'm going to basically do is I'm going to do my own I'm going to buy whatever is there in the index. I'm just going to buy it. On an average, it has given 12.3% return on an average year on year, which is quite good, basically, guys. I mean, it's quite good. It's amazing, by the way. And going forward, I don't think that the Nifty will be able to generate less returns than this. I think the Nifty will be doing much better. If not, because India is a growing economy, and the decade ahead seems to be very promising for India, particularly because in 2024 the elections are coming. The government is not going to let the stock markets down. It's going to, pump up the rally in the stock market. And even if you're looking ahead, China is rapidly being degraded in terms of manufacturing hub, and India is actually gaining a lot of that, and we provide the best service in the industry. And we Indian people are some of the best consumers out there, so we consume most of the things we produce. So we are a net importer, not not a net exporter, because we consume all the goods and services that we produce, and which is a very good sign for the stock market, right? I mean, if you have those many people in your country, that actually means that all the stocks that you're holding, for example, there are stocks such as Hindustan Unilever. So what are the products that Hindustan? Lux and Dow and Brew Coffee, Three Roses, and all these other and so Surf Excel, and all these brands that they really have. And even something like your favorite Magnum ice cream also is is also a part of Hindustan Unilever. It also sells, all these washroom sinks and all. I think you have seen the symbol, Unilever symbol on top of that. You also have your Sunsilk products. You also have your coconut oil that generally the ladies use. I think it's Parachute. It's that is HUL. So doesn't really matter if the market is up or down. People are just not gonna stop buying their essential products. So if you see something like Pidilite, many people might not have heard of this company, but Pidilite is actually the manufacturer of this famous brand, which is called as Fevicol. Believe me, guys, Fevicol, Pidilite's revenue is more than what we actually think. Its revenues is not just coming from these glues and the thing that you're using in your classes. It's coming from all different kinds of sources. Carpenters use a lot of Pidilite, right? I mean, Pidilite is one of the foremost. It's actually it has the largest market share when it comes to this adhesive industry. Okay, so it's comes under this resins industry. So this synthetic resins, I guess that's the industry it is in. It is a market leader. It has an lion share of 80% in that particular industry, and it always innovate with its products. It is buying out new companies in our country. The Dr. Fixit, Fevicryl, Fevicol, I think even Feviquick, and a lot more products are in their array of products, and they have a very good brand name. They have such a huge moat. I told you about the word moat yesterday. It means competitive advantage, that if anybody goes to a shop, he doesn't ask for a gum or glue. We just say, भैया मुझे फेविकॉल दो या मुझे फेविक्विक दो. It's as simple as that. It's synonymous with the same thing. So you have HUL, you have Pidilite. You also have companies like your favorite banks. For example, which bank do you think is the most classiest of banks? I think that would be HDFC, or maybe you like ICICI Bank. So it's very important for you to see what you're investing in. And TCS and Infosys, who doesn't know? TCS and Infosys always, hire in bulk. That means that the business is going really good, and they're going to do well even in the future. So what I'm basically going to do for you is I'm going to show you the tool that you can use for selecting your mutual fund, and I'll be telling you one mutual fund which I particularly like, which I invest in, which you should also think of investing in. I will show you what's in the mutual fund, and I will show you its history as well, and who runs the fund and everything. So yes, so let's quickly go to this YouTube, to this Google and mutual fund screener. So if you go to, if I'll just show you how to do that, you can just go to ticker tape. This is how it looks, and you can press on this. You can see this stock screener, there's a mutual fund screener. Select the mutual fund screener. These are the total amount of funds. Remember guys, there are three types of mutual funds. There are equity funds. Equity means stocks, guys. Okay, equity. There's debt means short term, like there are like corporate bonds. They are like they have a very short term maturity. Corporate bonds, they're like government G6 government securities. Even FDs and all also considered, this. And there are also gold mutual funds. I would precisely say not to invest in gold mutual funds. They're a very bad idea. They're a hybrid mutual funds. Generally are a mixture of equity plus debt. I'm telling you, do not do that. Instead, if you're really that much of a fan of diversifying, then I would say put 70% or 80% of your money, chunk of your money in equities, and remaining 30% you can put it in short term. And I would say invest in treasury bills. Maybe I'm going to make a video on that, and you can invest some of that in corporate bonds, or maybe you can also invest in bond mutual funds separately. But believe me guys, I mean, the returns are not going to be that awesome. Always remember, we buy stocks so that we can live well, but we buy stock by we buy, but we buy bonds so that we can sleep well. It's as simple as that. We buy stocks so that we can eat well. That means you can eat whatever you want if you're investing in stocks, because it magnifies your money. But when you're investing in bonds, what you're precisely saying is it's a very short term maturity. The returns are not going to be that well, but it's a more consistent, less volatility. So you can think of investing in that. But that's what it is. So do not invest in hybrid ones. They have pretty high expense ratios, so don't do it. Right, and let's quickly go to this. This is it. I'm going to select equity. You can just tick it equity, that's all. It's as simple as that. See, Kotak flexi cap means generally it has no barriers. It can invest in large cap, mid cap, small cap. So maybe you can think of holding this Kotak Flexi Cap Fund. It's actually quite good. The assets under management are 37,766,000 crores. So they're quite liquid. That means in times of any crisis, if people are drawing away money from mutual funds, you don't have to worry about it. It's a very vast um, assets under management. But does such a situation arise? See, what happens is the stock market in the short run is like a voting machine, but in the long term, it's a weighing machine, right? Whatever happens, people just don't get out of the market. We had some of the worst crashes uh, at the start of the century. We had the 2008 economic collapse. We had the 2000 the dot-com crash. We had the 2020 COVID crash. But believe me, the markets have always been on a bull run if you're going to consider a long time frame. So the best way in which you can reduce your risk when you're investing in the stock market, or maybe through mutual funds as well, is for being in it for the long run. Do not get completely panicked just because people are selling, or do not buy just simply because you are just because people around you are buying. Be a little more rational, reasonable, and do what the wise people always said. I'm telling you, things eventually will revert back to the mean, right? Nifty will not stop giving 12.3% return on an average. See, if you're going to see the Nifty returns year on year, in some years it even went 50% down. When you're investing in mutual funds, expect your mutual fund to go 10% down in like maybe once in a 1 year or 2 year. Maybe it will go down like maybe 30% once in a 4 years. But what you're basically going to do is you're going to invest for the long term. That's as simple as that. So try to be invested in the market as long as possible, and maybe that's going to completely minimize your risk. It's as simple as that. Do not basically track your mutual funds every single day, like today it's up, next day it's down. Okay, so it's as simple as that. So my favorite one, I think it's Kotak Flexi Cap Fund is good. You can go with this. And my favorite is Parak Parik Flexi Cap Fund. It has given an average CAGR of approximately 22%. Believe me, this 22% return is actually quite great. If you can actually consider to 5 years, it has given 16.2 to 9%. So in the future also, maybe it can give very good returns. I basically like it because I like the fund manager, this person. There are many people out there. All of them are very good. Mr. Rajiv Thakur is actually a well-known fund manager. If you look at the portfolio, you would see there are very good stocks in the portfolio. HDFC Bank, my favorite stock. Bajaj Holdings, ITC, very good business because they're actually experimenting in the FMCG and also in their agriculture business, which have a very rapid growth potential. They're building a lot of brand value there. They have an hotels business as well. ICICI Bank. The only stock which I don't like is HCL Technologies, but it's fine, 5% only. But if you're looking at most of the stocks in the portfolio, um, you are just looking at very good kind of like Axis Bank, Power Grid Corporation, Microsoft. This is what I'm saying. This fund actually has in it foreign stocks as well, 4.9%, Alphabet. So you also have Amazon. So basically, it also has an international exposure. So the Indian stocks are not going to do well. The maybe the American stocks do well. It's quite unlikely because these days the world has become globalized. Everything is interrelated, but it has been found that one year the S&P 500 will be up and the Nifty will be down, so you can actually expect. See, Meta is there. So Meta is actually Facebook, guys, for those who don't know. So Facebook right now is experimenting in the metaverse space. It seems that the fund manager also believes in that. I believe in Meta. I hold it. I think it's a very good company. It's a value play right now, because Facebook is basically the only company which is actually investing that much amount of R&D into the metaverse. So I hope that it succeeds. Motilal Oswal Financial Services, some of the premier financial services in India. Multi Commodity Exchange of India, a very good stock as well. So you're looking at a quite great mix. I think if you really want to start investing into mutual funds, always invest in this. Typically, because this year the stock has went down, the mutual fund today, if you look at the mutual fund return, see, uh, if you look at the overview, this is the stock for this one year. The stock is down 6.5%. So don't be saddened because of this, right? You're gonna have up run, you're gonna have down runs, but generally the bear markets tend to be very low and the bull markets tend to be of longer time. That's basically what you're expecting over time. No matter what happens, today your mood is good, tomorrow it may be bad, but over the long term you want to be an upwards graph. That's it. That's as simple. The slope should be positive. So if you're looking at it, it's a very good. This is 2020, guys. I mean, till now the stock has like went up like this. So in like 2 year return, if you're looking at the approximate 3 year returns, 22%, guys, quite good. 5 years, 16.29, max 18.5%. You are looking at a very great way of compounding your money. You can build a very long term wealth if you're actually going to use this mutual fund. I like it. The expense ratio, basically, it's a large size fund. It basically invests in large cap funds only. It also invests in US stocks, basically tech stocks. Tech stocks tend to be very volatile. They go down a lot, but come on, guys. Do you know Apple, Microsoft, and Google and Facebook? They are the most cash flow generative companies out there. So they can be volatile in the short term, but in the long term they're always cash flow generating machines. I basically have been investing a lot in the American stocks currently because the tech stocks are down a lot. It'll be for the short term, but in the long run I believe that they will be generating a consistent money generating machines. Yes. What is the expense ratio, guys? 0.76, very quite considerate, still between my limits. And for a fund which is actually earning you 18.5% over a 20 year 10-year period, you're basically giving like approximately, after taking away the commissions, you're basically earning 16% returns. Quite good. You're doing 4% better than the market. And I'll tell you, over the course of time, you can just go down, you can check your returns, invest monthly 15,000 for like how many years, guys? You want to invest for 10 years. For 9.5 years, you get 40 lakhs. 17 lakhs was your investment, 25 lakhs is your returns. And after removing the taxes, you're earning 40 lakhs. But if the same thing, if I basically temper it, simulate it, this is the average return. I am basically saying only 12.3%, which is the typical Nifty return. And now I'm going to check, see, just 29 lakhs. So that's what small difference in the percentage um, actually leads to, right? A very small difference in the percentage returns gives you a very large difference in your outcome. You can check that for your favorite, our moms and dads favorite FD as well. put in 5 in here or 6 if I want to be considerate. Yeah, 22 lakhs, guys. 17 lakhs was your investment, 5 lakhs was your returns. I know, pretty bad. So never do it, by the way. So this is it, guys, and I hope that the video was nice. Maybe you found it informative. If you like it, you can please like, share, and if you want, you can subscribe as well. Thank you so much.